So this chapter 10, is focused primarily on identifying the variances that a company will experience in terms of its actual performance relative to its budgeted expectations. So when you're doing this type of analysis, the best way to present your solution is in this format, where you have your actual results, your flexible budget, and your static budget, and then your two variance columns in between. So try to set your solution up in this way, because it's a better presentation and you're more likely not to miss things if you do it this way. So in terms of identifying what we have here, so the static budget, what that refers to is in the previous year, the company would have developed a budget and would have predicted how many units are going to sell, what the selling price would be, and what the price per unit would be costing. Then, for your flexible budget, what you're doing here is you're saying, okay, I didn't get as high a number of units being sold as I had thought. I got 140,000. So what should the cost have been at the lower level of activity? So what cost and sales level would you expect at 140,000 units? And when you're looking at that, what you're doing here for the flexible budget, you are taking your actual units and you're multiplying that by the budgeted cost. So we'll start off first with our actual figures. So our revenue is actually based on, of course, 140,000 units sold, and you actually sold them for $9.50 per unit rather than what you had thought you'd sell them for, which is $8. So that's where the 1330 is coming from. Your variable expenses is based on the 140,000 units sold, and the actual cost per unit in variable expenses came out to be $2.30. Multiply these two, you'll end up with your 322. Your fixed expenses, no calculation required there. That's given to you in the problem. Add those two together for your total cost, subtract that from your sales, operating income of $588. So when you're working in a company, your system will give you, of course, your actual results. And typically either your accounting system or your spreadsheets, wherever you've prepared your budget, will give you the information on what your budget expectations were. So once you know your actual, what you're doing here is comparing it to your budget. So what you're really trying to do is say our actual results were $588 operating income. And your operating income from a budget perspective, what you had thought you were going to earn $441. So you have a variance which is favorable, which is always nice. You have a favorable variance of 147,000. So that's your very favorable variance. So you're trying to explain how the company could basically sell fewer units, 5,000 fewer units, but still end up with a higher operating income. So the next thing we want to do is establish, okay, now that you know you've sold a lower number of units, what should the cost have been for selling 140,000 units instead of 145. So obviously your revenue is going to be impacted, and so will your expenses. So what we're doing here for the flexible budget, we're trying to identify what the cost should have been based on the budgeted selling price and the budgeted cost if we'd only sold 140,000 units. So here you're looking at your revenue. You would have 140,000 times the $8, because you had budgeted to sell them at $8 each. That's where the 1120 is coming from. The 308, that is that's based on your budgeted selling price, or your budgeted expenses, times the 140,000 units. And your budgeted fixed cost would be $400,000, and that's given to you in the problem. So the difference between your sales and your expenses is $412,000. So when you compare your actual results based on sales of $140,000, you would have expected your operating income to be $412,000. So you've got a favorable variance of $176,000, which is simply calculated by taking actual less flexible equals your 210. 322 less 308 equals 14, and so on. So here you have a favorable budget variance of $176,000. And the reason why it's favorable is because you actually sold your selling price here was $9.50 instead of your budgeted $8, which is giving you a favorable variance of $210,000, which offsets the unfavorable costs that you ran into during that period. So the objective here is that your financial system will tell you what your actual results are, and of course you have your budget already developed. You would have done that in the prior year, whether you did it in your accounting system or you could have done it offside on an Excel spreadsheet. So the objective here is to explain to senior management what made up the favorable variance. And so you can see here what you're trying to do is take the 588, your actual, you had your budgeted operating income of 441, so you had a favorable variance of 147,000, which is a good thing, but it's helpful and very beneficial for the company to know how that came about. So when you're setting up your spreadsheet to do this type of variance analysis, it's always a good idea to do it in this format. And it's, while you can probably come up with the same answer using another format, this is your best format to use. It's what you would be expected to provide in a company, and certainly in terms of doing an exam, you're much less likely to miss things if you set it up in this format. So the first thing we'll do then is look at our actual results, which is 140,000 units sold, and you sold them at $9.50 each. So you sold them for a higher price. That's how you're coming up with the 1.330. Your variable expenses, they actually came in at a bit of a higher cost than expected. So your variable expenses came in at $2.30 at $2.30 per unit. So that came to 322,000. Your fixed expenses, the actual fix is given to you in the problem, so no calculations required. You add those up, subtract them from the revenue, operating income of 588. So now the next thing you want to do is say, well, okay, if I sold fewer units, well, of course I would expect to see lower revenue and lower expenses. So that's what you call your flexible budget. You're saying, well, if I sell less, then what should I have expected to see in terms of revenue and expenses? So based on 140,000 units, you would have expected to see 140,000 times your selling price of $8 to give you 1.120. So for the approach to take here when you're doing your flexible budget, you're going to take your actual units and multiply it by budgeted selling price or budgeted cost. The next one here, the 308, so for the 308 in your variable expenses, so it's 140,000 times your budgeted variable expenses of 220. That's the 308. The 400,000, that is your budgeted fixed variable, budgeted fixed cost, so there's no change there. So now what you're doing is you're comparing your flexible budget to your actual. So you're just subtracting one from the other. So here you can see your sales. The 1330 less 1120 will give you 210,000. So your sales are 210,000 higher. So even though you sold fewer units, you ended up with higher revenue because you actually charged more per unit. You charged $9.50 instead of $8. For the other accounts, you ended up with an unfavorable variance because your cost per unit for your variable expenses was higher. It was $230 instead of $220 per unit, so you ended up with an unfavorable variance of $14,000. Your fixed expenses, they should have been $400,000, but they ended up at $420, so that's an unfavorable variance there of $20,000. So the total variance here, you have your 210 favorable will be offset by your 34 unfavorable, so it's 176,000 favorable variance. So that variance is totally due to having looking at what your budget should have been for selling 140,000 units at $8. So now the next thing you want to look at is what is the difference between your flexible budget and your static budget. So your flexible budget is based on 140,000, which is what you actually sold, whereas the static budget was based on your expectation of selling 145,000. So all you're doing here is taking the difference between the static and the flexible. So 140 compared to 145 is 5,000 unfavorable. 1120 minus 1160, 40,000. So here, and the expenses, your fixed expense or your variable expenses, they came in at 308, whereas you had budgeted 319. It's 11 favorable. So when you add all of that up, you see that the sales volume variance led to an unfavorable sales volume variance of $29,000. So just to summarize, our 147,000 favorable variance overall is actually made up of two components. You have your flexible budget variance of 176 favorable. Then you have your sales volume variance of 29,000 unfavorable. So the difference is your 147. So that's how you're explaining the total variance that the company has experienced in its actual sales compared to static. So that concludes problem 10-22.